Gold and silver just dropped nearly 10% this morning, wiping out over $3 trillion in under an hour. This kind of volatility never happens in gold. Not like this, not this fast. Bitcoin fell alongside precious metals, down over 6%, adding to the confusion and frustration. At the same time, the Fed is openly dismissing the message being sent by the world's oldest money, while the Trump administration appears willing to tolerate a weaker dollar and a historic repricing of gold. It's becoming more clear we're living through a highly unusual monetary moment, one where traditional signals are breaking down, narratives are colliding, and Bitcoin just feels stuck. Today, we're going to step back and look at what's really happening beneath the surface, because the reason Bitcoin feels so stuck right now isn't obvious, and it isn't what most people think. Welcome to No Second Best, the show where conviction meets reality, and reality points straight to Bitcoin. I'm your host, Hurley. Now let's get into it. Bitcoin's drop back down to 83K this morning is solidifying terrible sentiment felt across the industry. January is looking like it will be the fourth straight red month for Bitcoin, and everyone's feeling unsettled. Many Bitcoiners are feeling FOMO, as gold and silver have had one of the greatest runs in modern history. AI is dominating in tech hype and headlines, and commodities are screaming reflation. With this type of asymmetry in the market threatening long-term conviction, of course, theories are abounding. Maybe it's price suppression. Maybe it's quantum FUD. Maybe gold and silver are just stealing the debasement trade narrative. Maybe crypto contagion is dragging everything down. Maybe banks are slowing adoption. Maybe OGs just keep selling. And look, some of these are probably true, and a few are definitely contributing to the price lag. But none of these explain the core disconnect, which is what we're going to get into today. But first, to help understand where we're at, we need to start with what gold is actually telling us. Everyone knows gold and silver have made insane moves, specifically over the last month. Both have looked more like meme stock or the 2013 Bitcoin chart than the oldest monetary metals on Earth. And then this morning, the massive drop. Now, gold specifically doesn't move like this in healthy systems. First of all, it doesn't go vertical. It doesn't trade like a meme coin. And it doesn't violently reverse in a single day or week, let alone an hour. This behavior is clearly a stress signal, and Caitlin Long put it perfectly on what Bitcoin did. Here's how she frames what's happening right now in precious metals, and why chasing the move blindly could be dangerous.
And that's what we're experiencing right now with gold and silver. We're seeing an incredible short squeeze. I would caution, though, before people think that this is just going to keep running and running and running and running, it may not be different this time. And if you look at gold, or sorry, silver in particular, there have been, this is the third parabolic increase in the silver market since 1980. And in each one, the silver price just goes parabolic for a very short period of time and then collapses back down. Is the third time going to be different? Only time will tell. I mean, there's some fundamental reasons why it may be different this time, but there are also, the history in that market is that it goes through these parabolic rises, and that the right trade, if you look back historically, was to take your profits when they happened. I'm not giving investment advice. I'm just suggesting that folks go look at the history and use your own judgment, and be careful chasing these things, because they certainly can run. But I will also say, when you think back to, it was 1980 and 2011, I believe, were these parabolic rises in silver, and then they crashed pretty fast. If you go back and look at what gold and platinum and palladium did during those same parabolic rises in the silver market, they did not have parabolic rises like silver did. Now they are all having parabolic rises at the same time. So
something is different.
I'll let you draw your own conclusions.
That last point on silver specifically is important. Silver has done this many times before, and every time supply responded. Every time price collapsed. In fact, Saifedean Ammous explained this years ago in the Bitcoin Standard. When silver rises, miners ramp up production, supply floods the market, and savers get wrecked. Now this time could be different, as Caitlin Long pointed out, but it's important to know the history. Gold, on the other hand, holds its role much better, but even gold is reacting to something much bigger than inflation. It's reacting to a loss in confidence. And here's where things get truly strange. Because while the world's oldest hard monies are going parabolic, the most powerful central banker on earth, the guy who turns the monetary dials and moves markets with his words, says it's no biggie.
As I'm sure you've noticed, gold and silver prices have experienced historic gains of late. And I'm wondering how much attention, if any, you pay to those moves, and what message you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically.
the argument can be made it's, that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
What an astonishing thing to say. Gold is the world's oldest and most trusted store of value. Central banks have been accumulating it aggressively for over 3 years straight. It just overtook the dollar as the largest reserve asset by market value. And the Fed's response is this? I don't think this is confidence. I think it's blatant avoidance and posturing. And the dismissal actually tells you exactly why gold is running. Not because markets are worried about inflation, but because monetary credibility is breaking down. And of course, the leader of the Fed has to show confidence. But while this loss of credibility can push capital into gold, it doesn't create freedom, because that's where gold still falls short. You see, gold works until it works too well. History is very clear on this. When gold becomes a real escape valve, it gets confiscated, it gets restricted, it gets criminalized. Every major global power has done this throughout history. Gold minimizes debasement risk, but it does not minimize permission risk. And that distinction is where Bitcoin enters the picture, and where most people get lost. Bitcoin legend and cryptography OG Nick Szabo really nailed this point recently on X in some responses to someone understandably questioning Bitcoin's role as a hedge against currency debasement. Here's what Szabo wrote. It's hard to tell that Bitcoin protects against debasement from just its price, since most of the price rise since the pizza purchase has been due to the learning curve, not to debasement. Fiat has fallen, but not nearly as much as Bitcoin has risen. To understand why Bitcoin has and very likely will protect in the long term against debasement, better than gold has and will, requires deep understanding of the underlying respective technologies that are gold and Bitcoin, especially in terms of their respective extents and qualities of trust minimization. And it requires knowing why trust minimization is valuable. These kinds of understandings are still uncommon. Gold has thousands of years of being looted and hundreds of years, including the present, of sitting in vaults, its trust minimization properties relegated to ancient history, because it's far more expensive than Bitcoin to validate. You are another example of the vast majority who have little clue how this stuff works, or why it's valuable. And that vast majority of ignorance is why the Bitcoin learning curve has plenty of upside left to ride. People look at Bitcoin and say it protects against debasement because numbers go up. Szabo says that's missing an important point. Bitcoin's real value isn't just scarcity, it's also largely trust minimization. And most people still don't understand why that matters, including Wall Street.
Here's the bottom line. Wall Street will never control Bitcoin in the way that it was able to control gold. Why? Because gold was always stored in the bank's vaults, including the central banks. So the individual ownership of gold has never been more than a few percentage points, whereas the individual ownership of Bitcoin, it's the vast, vast majority. Yes, there have been some whale selling, some OG selling as it topped $100,000, right? But it's still, 70% held in long-term hodlers' hands, give or take, right? So it's still a relatively small portion of Bitcoin that trades every day. And the long-term hodlers are not going to be bailing out Wall Street. They're not. And so that's just never, that supply is never going to be available for Wall Street to come in and financialize. So ultimately, you made a very good point, and we talked earlier about how Bitcoin is purely voluntary. So Wall Street can come in just like anybody can come in. They can play their games. They can also blow themselves up, which I think they might do. Somebody will. But by the same token, just the fact that anybody with an internet connection or even a ham radio, I have seen a Bitcoin transaction done over ham radio, okay? Anybody who can communicate with another human being can do a Bitcoin transaction. That means it's entirely voluntary, and that means we can always go around Wall Street. Nick Szabo made a really important point at the Bitcoin conference in Miami right after COVID. So this would have been Bitcoin 2021, I think, where he said, we don't need liquidity. We just need to have some market at all. And I'm poorly paraphrasing his point, but I thought that was the most profound observation about Bitcoin, especially given that he might be Satoshi. It was a very important observation that he's basically saying we shouldn't be applauding all these institutions coming in to try to make your bid offer spreads very tight because the markets are very liquid. All you need is the escape valve. And the fact that Bitcoin is voluntary and governments cannot co-opt it and cannot ban it, even if they try, they might be able to tax it. And of course, a lot of people will not go to jail and pay their taxes voluntarily on it. Again, hat tip to Pierre for staying on that. It is the biggest point. And by the way, Nick personally made that point to me years ago, that the number one thing that we can and should be getting done in Bitcoin is taking taxes off it. Forget all the regulation, that's secondary. Let's get it so that it's not taxed. But, back to your point, the fact that Wall Street will never really control it and we can always just voluntarily come and go as we please, that is the escape valve. And no government can block us from using it as long as we can communicate with another human being, whether the internet is up or not.
This is where so many narratives collapse. Ownership is not control. Corporations owning a lot of Bitcoin does not centralize the network. Bitcoin's decentralization is enforced by nodes, miners, and consensus rules. Bitcoin doesn't care who you are. It doesn't ask permission. And it most definitely doesn't live in vaults. Which brings us to another critical point most people miss. In Bitcoin, self-custody is the thing.
All these derivatives games are suppressing the price. A lot of people think they're buying real Bitcoin. They're not buying real Bitcoin. And there was just a kerfuffle over the weekend with Jameson Lopp and Michael Saylor talking about the biggest threat to Bitcoin. Michael was making the point that it's people who want to change I think it's ambitious developers who want to change the code. And Jameson's response was no, it's concentration of ownership in centralized institutions that are not engaging in self-custody and that are engaging in these sort of, yield plays. If you're engaging in a yield play on Bitcoin, you don't own real Bitcoin. You own a claim to Bitcoin. And in the event that there is a short squeeze, guess what? There may not be a chair for you in the game of musical chairs.
Claims are not assets. ETFs, yield products, and derivatives don't give you Bitcoin. They give you exposure to Bitcoin. They're promises layered on top of the asset, designed to satisfy demand without forcing delivery. And for a while, that works. It absorbs capital, it dampens volatility, it makes Bitcoin easier to own on paper. But that convenience comes at a cost. Because when trust breaks, when counterparties matter again, claims don't settle. Assets do. At that moment, it doesn't matter what your statement says. It matters who controls the keys. This is why we always stress the importance of self-custody at Swan. Bitcoin only works as a bearer asset. Once you turn it into a claim, you're reintroducing the very trust it was designed to remove. So all of these Bitcoin derivatives aren't necessarily bearish for Bitcoin. It's just another lens to view how early we still are. It means the market is still learning what it actually owns and what it doesn't. Here's the truth. Bitcoin is still wildly misunderstood. Not just by retail, but by institutions, policymakers, and even some Bitcoiners. It's not just money. It's not just tech. It's not just an asset. It's the world's first trust-minimized monetary system. That takes time to understand. And that knowledge gap is the asymmetry. Gold feels intuitive. Bitcoin doesn't. Most people think they understand gold because it's tangible. It's shiny, it has weight, you can hold it in your hand. That makes it feel like money. But very few people can actually explain why gold became the dominant money. Not because it's pretty, but because it was scarce, durable, divisible, portable for its time, and extremely difficult to produce. It did a good job at resisting debasement in a world without digital communication or global settlement. Gold didn't win because people voted for it. It won because over thousands of years, it outcompeted everything else. Bitcoin, on the other hand, has no physical form. You can't touch it, you can't see it, and it doesn't feel like money at first glance. To truly understand Bitcoin, you have to reason from first principles. You have to forget what you think you know. You have to understand trust, verification, scarcity enforced by rules, and why removing intermediaries matters more than having something you can hold in your hand. It's definitely counterintuitive. And anything counterintuitive takes longer to be understood. That delay, the gap between intuition and understanding, is where the asymmetry lives. And until understanding catches up, price lags. When you understand Bitcoin this way, it stops being charts, cycles, and headlines. The real question becomes execution. How do you actually hold something that's designed to remove trust? How do you pass it on to your loved ones? How do you hold it across decades? That's what Swan Private was built for. Swan Private works with individuals, families, and businesses who see Bitcoin as a long-term monetary asset. With Swan Private, you work with a dedicated Bitcoin advisor, a real person that you can call or text, who helps you build a long-term Bitcoin strategy using Swan's full platform. That includes collaborative self-custody cold storage, inheritance and estate planning, tax-advantaged retirement accounts, and tax-aware structuring. If you're thinking in decades instead of cycles, head over to swan.com/no-second-best and meet with the Swan Private team today. So to close it out, Bitcoin doesn't need hype. It doesn't need narrative validation. And it doesn't even need gold to fail. It just needs time. But now I want to hear from you. Do you think Bitcoin's biggest obstacle right now is price or understanding? And what finally made Bitcoin click for you? Let me know in the comments. Don't forget to like this video if you got value out of it. Maybe share it with someone who's confused right now. And of course, subscribe to the Swan Bitcoin channel so you don't miss the next video. Thanks for watching. Have a great weekend, everyone. Go touch some grass. And remember, there is no second best money.